Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically we are discussing upon the Indian banking system. Okay, and basically what we are trying here, basically we are trying to connect the past with the present and then taking it to the future. Past, present and then future. Okay, so this is the, you can see the area basically we are talking. All right. And these are the topics which we had planned to cover in this particular IBS series, Indian Banking series. And so far, basically, we had done with the generations of banking. All the four generations we had discussed in detail. Thereafter, we had discussed upon the banking sector development 2014 onwards, in which we had discussed the gem trinity. Okay, we had discussed the revolution, and you can say the efficiency brought up by the payments and small finance banks. Okay, so these are the things which we had discussed in these two headings. Now what we are left with, basically we are left with risk in banking. Okay, so now in this particular lecture we are going to start with the risk in banking. I hope that you have revised the previous topics in a well enough manner before you have come for this lecture, because as I have told you many times, it is for your own benefit. Okay, so this is the topic we are going to start in this particular lecture, means risk in banking. Okay, so before this, let me discuss with you some facts and figures so that you can say we could understand it better. All right, when we talk about the bank, so what is bank? And what we talk when we talk about the business, what is business? These are the two terms which we should understand first before we go forward. Business and the bank. All right, so let's start with the business. Business, you can say, is kind of an activity in which some services and product sold by an organization, or you can say offered by an organization, with the motive of earning the profit, which is the income source of the business. All right, while when we talk about the banks, then we know bank primarily having the two functions. First is accepts a deposit. Second is grants a loans. Okay, they having two main functions. All right, but as we had discussed many times in the previous lectures also, here also we are going to discuss the same. When we talk about the deposits, we know, and deposits, basically the bank gives some interest rate. Okay, on loans we know that the banks charge some interest, right? So if we look at the figures, this is what they providing to the depositors or to the outsiders. This is what they're receiving from the outsiders, and you can say from the loan holders. All right, so if we minus 6 minus 4, we will see that 2% is in excess, which we always called as an profit. Okay, so basically the bank is also a business. Why? Because as we had seen that in business, some goods and activities are being sold and offered respectively in order to receive the profit. Similar things happen with the banks. Banks renders the services of accepting deposits and granting loans with aim of making the profit. Okay, so banks are also the business which we also call as a banking business. Got it? Now, this is just an you can say the relation between the bank and the business. Now, the second term which I would like to discuss with you all is that whenever we talk about the business, there is one thing which is associated with it. It's called the risk or the risk factor. All right, because suppose, for example, you can say this is a particular business established by XYZ. Sorry, XYZ is a particular business established by Mr. A. So it means that Mr. A had invested the capital, had invested the resources, okay, made the efforts, all right, invested the time, all right. All of these things he had invested in the XYZ in order to get the desirable profit or growth results. Got it? So this is the main aim why the person A is putting all these things in this particular XYZ. Okay, but there are something which we call as a controllable and the uncontrollable thing. Okay, controllable and the uncontrollable. So when we talk about the controllable, it means that these are the insider factors. Okay, means these are that factors which are under the control of Mr. A or under the control of XYZ, like the labor of the company, like the capital, like the plant and machinery and all. All right, the uncontrollable factors, the uncontrollable factors are the external factors, okay, which are not under the control of the Mr. A or the XYZ. These are the political situation, the economic crisis, the market equilibrium, and so many things. All right. So, in order to receive the desirable result or profit, in order to receive it, it is very, very necessary that the controllable plus controllable plus uncontrollable factors, they both must be in accordance with the desirable results. If not, if any of them is in unbalanced condition, the things will be, you can say, adverse. All right. And if the things are in adverse condition, which means whether you have invested the capital, resources, efforts, time, whatever you had invested in the business will not give you the desirable results. Okay. So what do we call it? We call it as a risk. Risk means what if we invested all of these things? Okay, what if we invested all of these things, is still we not obtain the desirable results which we are planning for? Got it? That's the main thing. All right. So similar things happen with the banks also. Like assume the XYZ is a bank. Mr. A founded it. So they will invest the capital, resources, efforts, time, whatsoever, but still the consumer base is not as desirable. Okay. If the defaulters are in the excess. Okay. So if any of such conditions happens, what will happen? The bank will be collapsed, or you can say would start suffering the huge losses. Okay. So these are the, you can say, facts and figures regarding the risk in the business. And now we have to learn them in order with the banking, which we call as a risk in the banking. All right. So let's start. First is the infrastructure and the capital investment risk in banking. Overview. Let's see the overview. Remember infrastructure and the capital investment risk. First one. The bank lending for the infrastructure and the capital investments, especially those linked to the state government entities, poses specific risk due to the nature of these projects and the financial health of the states involved. All right. Banks need to assess the risk carefully and manage them effectively to avoid defaults. Like if we talk about the infrastructure and the capital investment. Okay. So first of all, remember, whenever there is a this kind of situation, so there are two main things. There are two main things. The first is the huge capital requirements. Okay. Second one is the various stakeholders involvement. Okay. So these are the two main things in these particular projects, like the infrastructures and you can say the capital investments. All right. Because the huge capital means, suppose if, just take an example, there is a two projects. First is an highway bridge, for example. All right. Second example we could take that there's a you can say state owned factory. Okay. So if we take the first example of a highway bridge, suppose there is a construction of the highway bridge. All right. So what do you think? What is the budget of the highway bridge? Even if you are just, even if we are just making the bridge of 100 800 meters, still this bridge will be cost around, minimum to minimum, will be 90 to 90 to 100 crores. Okay. It is the bare minimum cost, even if the bridge length is only about 800 meters. Got it? This is the huge capital requirements. Similar with the state owned factory. If the state is making any factory, a smaller to small will be of 500 to 1000 crores if we sum up the project cost. Okay. So now you can see that these investments are huge in the nature. Thereafter, various stakeholders involved, not even if we take the highway case, not only the state government will involve, the NHAI, you can see the bridge corporations, civil administration, various stakeholders will involve. Similar with the state owned factory. And this creates a diversified management. because there is a there is no, you can say there are multiple point of contacts. First thing, there are multiple distribution channel of the capital. Got it? That's why it is necessary that banks assesses their risk carefully and manage them effectively to avoid the default. Okay? Because generally these kind of projects are funded by the state governments, but in order with the banks. Okay? And for this kind of you can say things, basically the investment proposals are released by the state government, in which they promise the you can say fixed return, they promise the particular benefits the bank will have in future and all kind of things. Okay, so it is on the bank not to get distracted by seeing the benefits and all. Okay, but also seeing the disadvantages. Disadvantages associated with the investment. Okay, because if they having a clear picture of the advantages and disadvantages, they will manage it well. Thereafter, the risk or defaults in the infrastructure and the capital investment is higher due to the various factors. First is the long gestation period of such projects can strain the finances of the borrowers. For example, you can say, suppose this is the bank XYZ. Okay, they having you can say 100 crores, for example. Okay, 100 crores is a total liquidity they have, but could they lend out the entire amount? No, they have to deduct the CRR, they have to deduct the SLR, they have to deduct the PSL, priority sector lending and all. Then only, suppose 25 crores, for example, 25 crores have been deducted from these 100 crores in order to maintain all these areas. How much will be remain? ₹75 crores will be remain. Got it? So this 75 crores is now available with the bank for the loan and all the things. Okay. So for example, suppose out of 75 crores, 20 crores bank has granted as a loan to the general public, for example only, and the remaining 55 crores have been invested by the bank in the infrastructure or the capital investment projects. Okay, so first of all, if we look at this picture, what is written down here? A long gestation period. It means that the return which is promised on such kind of investment is not in a quick manner. It means that the bank will have to wait a long in order to get this particular project done and get the return as promised. Okay, in meanwhile, for example, suppose if the investment was made in 2019, okay, and suddenly it was 2020. Okay, the gestation period was 2019 to 2025, 6 years. But it was the year of 2020 when the people start reaching the XYZ. People means the depositors who had deposited their money with the XYZ. Okay, first the XYZ will use the reserve. It finished off. Okay, thereafter, even they arranged the 20 crores loans. They also finished up. Now they have the requirement of 30 crores. in order to meet the demand of borrowers. Okay, but 55 crores have been invested in the project with the gestation period of 2019-2025. So what do you think? Is the bank able to arrange the 30 crores and meet up the demand? No, right? That's the first issue. Like, long gestation periods of such projects generally strain the finances of the borrowers. Okay, first reason. Second, if we talk about the second reason is state finances, which often fund or guarantee these projects, can be volatile and subject to the budget constraint. Okay, for example, the state is A. Okay, the project worth rupees 100 crores, for example, and 10% promised on it. All right, it means that the state is entitled to provide rupees 110 crores to the bank. Okay, but during the gestation period, or in the meanwhile, you can say state A finances become unstable. Okay, and state A is now facing the budgetary constraint. Budgetary constraint. Okay, so what will happen? They were entitled to pay the 10%, but right now they are only able to pay the 2%. How much the bank expected? How much the bank will receive? Okay, so there will be a loss of total 8 crores. Okay, so this is the second main reason, like the state finances, which often fund or guarantee these projects, can be volatile and subject to the budget constraint because the gestation period is long. Changes in the government policies or the regulations can impact the viability of projects. Changes in the government policies or regulations can impact the viability of the projects. Okay, maybe because the long gestation period is there, maybe the government changed. For example, you can say when there was a state A, there are two governments or two government parties, government X, government Y. Okay, when the investment was made, 10% return was promised by the X government. But in the meanwhile, due to the election and due to some emergency situations, the government X was withdrawn and now the new government is government Y, for example. Okay, and government Y changed the policy of providing the 10% interest rate with only providing the 5% interest rate. Okay, so this change in policy is basically the loss for the bank, as they received less than what they had invested, or you can say they had expected basically. All right, so these are the three main reasons: long gestation period, volatile nature of the state finances, and the change in the government policies and projects. All right, setting internal exposure limits. Banks are advised to set the internal exposure limits based on the fiscal and the financial assessments of the individual states. This involves evaluating the financial health of the state government ability to meet the debt obligations, and the overall fiscal discipline maintained by the state. Like basically you can say, before making the investment into the state projects, the banks are highly advised to make some internal exposure limit. Okay, which also means that bank should you can say fix the investment cap, like how much investment they should make in any particular state. For example, you can say, suppose this is state A, state B. All right, both are claiming the 10% return. 10% return on the investment. Okay, this is the bank called as XYZ. All right, now both are claiming the 10%. Now it's up to the XYZ that they must undertake some internal research. Okay, make some queries and all the things, and then go along with the state A or the state B. Okay, for example, XYZ found that the state A's finance condition is a volatile, while the state B financial conditions are stable. And you can say good for the investment. Then what will happen? XYZ will go with this particular state. All right, because right now, due to their internal research, they had evaluated the financial health of the state government and the ability to meet the debt obligation and overall fiscal discipline maintained by the state in order to counter the long gestation periods volatility. Long gestation period volatility. Okay. Fiscal assessment of a state. Banks need to assess the fiscal health of individual state by considering the factors such as revenue sources and their stability, like from where the state earned and how much the stable is the earning, debt levels and the sustainability, budgetary discipline and adherence to the fiscal targets, and economic growth prospect and the diversification of the economy. Now these are the, you can say, main areas which indicates that whether the state having the stable condition or not. Okay, if the revenue sources are not stable, it's a volatile state. Debt levels and sustainability are higher than its ability to meet the obligations, it's a red cross. Budgetary discipline and adherence to the fiscal targets is a failure. It means that the state is not able to maintain its financial stability right now. Economic growth prospect and the diversification of the economy. It means that whether the state is inclined towards only on one sector of the economy or it's having the presence in all the sectors of the economy. All right. So all these factors taken into consideration while making the fiscal assessment of the state. Okay. Banks also need to assess the financial health of the states by considering factors such as liquidity position and ability to meet the short-term obligations, debt servicing capacity and history of the defaults, dependency on the central transfers and the grants, adequacy of reserves and the contingency funds. Okay. Setting exposure limits. Again, based on the fiscal and the financial assessments, banks should set the exposure limits for lending to the infrastructure and the capital investments linked to the state government entities. These exposure limits should take into account the overall risk profile of the state and the specific risk associated with the individual projects. All right. Thereafter, we have the risk management strategies to manage the risk associated with the infrastructure and capital investments, bank can adopt the several strategies like they could diversify the lending portfolios to reduce the concentration risk. If the one area is in the down, the second will be up so that the things could be managed. Collateral requirements to mitigate the credit risk. All right. To manage the risk, the other strategies are regular monitoring of the state finances and project performance so that they could be updated. Stress testing to assess the impact of the adverse scenarios, like what if this will be the scenario, how the state economy will respond. Okay, this is, you can say, simulation of some risk or the stress. Use of credit derivatives and insurance to hedge against the risk. Got it? So students, basically in this lecture we had seen some facts and figures regarding the infrastructure and the capital investment risk in the banking. Okay, we had discussed some facts and figures in this lecture. In the next lecture we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.